Time to welcome Saurabh Mukherjea, CEO Institutional Equities at Ambit Capital. Saurabh, it's been a while since I had a chance to catch up with you, so it gives me great pleasure to have you on the show today. But, you know, the key question that we're asking today on the show is the US Fed has made its move. What does that really mean now for life in Indian equities? You know, what are the risk factors that are going to play out now on Indian equities? Saurabh, I was saying, good morning. Good to be talking to you. It's been a while. Very straightforward question to you. Fed, out of the way. What does it mean now for Indian equities? What are markets going to focus on? Is it, what, risk on trade again?
Sure. So, Manvi, I think the picture is reasonably clear as to how we go forward. I think the best way to look at this is the last 18 months. The Fed telegraphed its intentions from the time it stopped QE. I think QE stopped around a year and a half ago. And once global markets woke up to the fact that interest rates in America weren't going to stay at zero forever, risk asset classes started selling off a year and a half ago. So if you look at the last year and a bit, emerging market equities have sold off, commodities have sold off, junk bonds in America are now selling off at a rapid rate. Hedge fund outflows have picked up appreciably in the last 6 months or so. And I think that journey will continue. That journey will continue through 2016, where gradually as the Americans normalize their monetary policy, as the Americans move back to what I would call a sort of sane monetary policy rather than a response to the Lehman Brothers crisis, risk appetite in America will also normalize. And as that happens, emerging market equities are likely to see outflows, and it's highly unlikely that India will be an exception to that. My hunch is that the outflows that we've seen in Indian equities on the FII front, I think we'll continue seeing that through most of 2016. Therefore, support from the Indian market is unlikely to come from foreigners. We are now largely reliant on domestic inflows to shore up our own stock market.
And as the last few months have demonstrated, the muscle power in the hands of domestic institutional investors, although they are buyers, will still not offset the gap that FIIs leave behind. So net, the trajectory southwards for Indian equities?
I think you're right. I mean, domestic equities driven flows will necessarily be a much more longer term story for a couple of reasons. The first being the fact that domestic equity quantum in the market is half or less than half of the foreign investor quantum. Something like 70% of free float in the Indian market is with foreigners. Domestic investors only have a third. So obviously the quantums are very unbalanced there. It will take a while for domestic to rival the FIIs in buying power. The second reason which worries me more, I have to confess, is typically what I've seen is domestic inflows are a function of the last 12 months returns. Now, as you know, the last 12 months returns for Indian equities aren't particularly pretty. And whilst we continue seeing good inflows into domestic mutual funds, I am a little concerned as to what 2016 will bring. And therefore, my take is over the next 12 months, this market's unlikely to give double-digit returns. 29,000 is our FY16 end target, but with a distinct possibility of 10-15% downside if the domestic investor takes fright and runs for cover.
I'm going to crisscross between local and global here, Saurabh, so bear with me. But, you know, as you look at the checklist for global factors, events that have an impact on Indian equities, you tick the Fed off now. So therefore, does that automatically mean the spotlight in a sense, or the scrutiny in a sense, shifts to China? And the picture out of China isn't heartening as well.
So let me address the China question in a minute. I wouldn't take the Fed off quite this early. I think what the Americans are saying, what the Fed clearly said last night, is that look, we have a gradual recovery in America, and hence we are minded to increase interest rates gradually. Implicitly, I think what they left the door open was, in case the recovery accelerates, they can step up the pace of rate hikes and vice versa. And hence, I think the Fed becomes month to month. I think the Fed will need careful observation on how they calibrate the rate hikes. But where life changes is, so far we were all living in a world of zero interest rates, zero American interest rates. That world is gone, and now we have to keep a very beady eye on how quickly the Americans hike rates over there. But coming on to China, I've said for a year now that the Chinese have very little option but to devalue the RMB. It would appear that that is increasingly the case. Their economy simply isn't kicking into life. They've tried monetary policy, they've tried fiscal policy, it hasn't yielded results. Exports are dropping sharply, FX flows are picking up, and I think it's reasonably clear to me that the RMB or the yuan will devalue through most of 2016. Just to put it in perspective, the yuan has revalued to the yen by around 40% in the last 4 years. That's a devastating blow for Chinese manufacturing. As the yuan now devalues by say 10-20% over a 2, 3, 4 year period, it's very difficult to see how the rupee will not devalue in sync. China is a mighty economy and a mighty currency. As the yuan devalues, I think Asian currencies, including the rupee, will have to follow in sync. Perhaps not step for step, but I think downward pressure on the rupee looks more likely than not over the next couple of years.
Makes the Reserve Bank of India's job fairly tricky. I mean, at least from the currency perspective. Saurabh, assess the real sort of job pressure that the RBI faces post the Fed move, and keeping in mind the Chinese devaluation of currency.
My reading of what the RBI has been doing is I'm not so sure they'll be that unhappy with a gradual slide in the rupee to say 70-ish levels. And the reason I say that is what I've seen with the RBI over the last 2-3 quarters is when the rupee starts to strengthen, they intervene very quickly. So take Q1 for example. We ended Q1 with a balance of payment surplus because we were getting capital inflows, especially in FII debt and FDI, and our current account deficit was very low because fuel price pressures had abated. And what I noticed was even though our BOP position was in very good shape, the RBI intervened to stop the rupee from strengthening. And then as soon as the rupee starts sliding, they're reasonably happy to let it slide to 67 reasonably quickly. And my reading of the RBI stance is that the rupee depreciates gradually, they're not that unhappy because it gives a stimulus to the economy. It allows us to stay competitive vis-a-vis China. So my reckoning is that as long as there's a sort of managed kind of depreciation in the rupee, the RBI will not be that unhappy about the fact. What they are trying to prevent is a big drop in the currency on the back of say hot money outflows.
Saurabh, this is Pankaj also joining in. I just wanted to focus on the point that you made that free money in the world is probably at the top, and now probably we should see decline going ahead. Earnings have not been growing. Once the free money ends or the liquidity tightens a little bit, focus on earnings will be much more, and you think the delivery of earnings has to be important for markets to outperform?
So clearly, whenever you have a period of very easy access to capital and an exuberant risk appetite, speculative plays, speculative companies, shaky business models tend to get funded. I'm not saying that will stop entirely overnight, but my reading of the situation is that the tide has turned. So in America, we've at least had, to my knowledge, at least a couple of IPOs in the last month where the companies have gone public at valuations below their final round of private equity investment. In India, it's reasonably clear that getting .com funding has become harder, and extending that to the listed market as well. I think availability of capital for substandard business models, even in the listed market, will be hard. The focus on quality, focus on earnings, cash flow, high ROEs, good corporate governance will, I think, become that much stronger over the next couple of years as capital becomes priced fairly rather than priced freely.
You said that your Sensex target is 29,000. What sort of earnings are you predicting in? Do you still believe it's on the higher side and downgrades are likely?
So for the current fiscal, 6 months ago for the current fiscal, I had said that we'll see around 9% earnings growth. I have to confess 9% now looks wildly optimistic for the current fiscal. We had hardly had any earnings growth in H1. So my reckoning is FY15, the current fiscal will end at around 3%, 4% earnings growth. For the next fiscal, for the year after that, we are going with 9% again. I think consensus has a high teens figure for FY17. Our figure is a 9%, which is half of consensus. My net take is double-digit earnings growth. Double-digit earnings growth is at least 6-7 quarters away in our country.
Right, the fall in the commodity prices will only make things look worse because margins may increase, but pricing power may actually go and sales may actually decline on an absolute basis because of the decline in pricing power.
Just 2 points to that. I'm not a commodities expert, but given how much commodities have corrected, if there's another major drop in commodities, I think we'll start seeing serious issues in the global financial system. You already have major commodities players pushing through big job cuts. They're trying to get debt reduced. If there's a big drop, there's another big drop in commodities this point in, whilst that'll be good news for us in the short run, it will inevitably be followed by a degree of global dislocation. So my read is we probably will see modest falls in commodities this point in. Now the reason that's important is if commodity prices don't keep falling, I think the margin benefits, the operating margin benefits that we got in H1 will not quite come through in the quarters going forward. What's really saved us in H1, the reason we were at least able to post flat earnings growth was operating margins came to the rescue. My reading is operating margins are not going to come to the rescue going forward, and hence the weakness in top line, the weakness in revenue growth will increasingly translate into sluggish earnings growth, hence my 3% earnings growth forecast for the current fiscal. But the point of view that commodities will fall radically this point in, it might be true, but hey, if that happens, we've got serious trouble coming for the global financial system and by implication for us.
Right. Saurabh, as we were speaking, and markets have actually slipped into the red, just blinking into red and green now, but we are about 150 points for Sensex off the day's high, and for Nifty about at least 40-45 points off the day's highest point. Saurabh, let's focus on the banking space. Private sector banks, you think even after the recent correction, valuations for corporate banks like ICICI, Axis, some of the other ones don't factor in the problems that they can see in on the NPA front?
I think there's three things which are happening in the banking system, which I think suggest that over the next couple of quarters we will see another ratchet up in asset quality stress. The first piece is playing out in public view of all of us. This is the whole issue which was triggered off by HDFC Bank and BOI declaring SR Steel as an NPA, whereas the rest of the banks hadn't done so. That's led to an RBI investigation, and basis what I read in the press, it would appear that anywhere between 100 to 150 loans will be declared stressed over the next couple of quarters, and provisioning for that I presume will follow through in sync with these loans being declared stressed assets. So that's highly likely to hit the public sector banks, but also I think ICICI and Axis will not be immune from the incremental provisioning costs that will come through. The second piece that seems to be playing out is a degree of concern on the credit rating agencies' parts, on the regulators' part, that even on standard assets, provisioning isn't quite what it should be. And I think that this is also something which I think the regulator will push over the next 3-4 quarters, and it will push the banks to increase provisioning levels to give the regulator comfort that we actually have a strong banking system. So leaving aside stressed assets, even on standard assets, I think there's a good chance provisioning will go up in the coming quarters. And the final piece, which is becoming increasingly obvious, is that as the economy stays in sort of reasonably sluggish shape, the NBFC sector, and there are reasonably prominent large NBFCs which are listed, there the asset quality woes are getting worse. And at some stage, these asset quality woes in the NBFC sector, I think, will spill over into the banking system. So as I've been over the last couple of years, I remain fairly pessimistic about the state of the banking system. I think we've got trouble there. But it looks finally as if we're approaching the climactic stage of this sort of NPA purge. I think finally the banking system might actually get to terms with the sheer level of stress that's hiding in the balance sheets of our banks.
Saurabh, what sectors should one focus on going into 2016, or what stocks do you think should do well, considering the Fed is behind, probably outflows are likely to expect, but still we are expecting decent returns for markets to come in?
No, so just to be clear, I'm expecting single-digit returns for the Indian stock market. Now, at one level, I can paint that positively by saying that the year that we are ending didn't give any returns, so single-digit returns from the stock market might not be such a bad thing. My take is there is no easy answer to the sector question. It's not as if, auto or FMCG or IT will be a sort of runaway success. I think we necessarily are looking at stock picking, or if you want to put it in sectoral terms, there are niche plays, niche themes that will work out reasonably well over the next couple of years. To take a couple of examples, road building is a sector where there's clearly government impetus. There's plenty of EPC work that the government is handing out, and I think that momentum will continue. Therefore, something like a Sadbhav Engineering as a play on road construction, both EPC and they also have a dozen odd good assets on the balance sheet. Sadbhav Engineering, I think, is worth looking at. The second area where there seems to be a ray of hope and a little bit of a recovery is urban consumption. With fuel prices having conked off considerably, interest rates down at 125 bips, this pay commission award coming next year, I think the urban consumer seems to have a little bit of money in his or her pocket, and that's going to get spent, I reckon. So a stock like Trent, the leading women's wear retailer in our country, a stock like Trent, I think, makes sense in that regard. But as you can see, I'm talking about small and mid caps. I'm talking about very niche themes, because that's the only way I can make sense of how our clients can actually make money in what is clearly a very tricky market.
Saurabh, I've been listening carefully to everything you've said, and we look forward to 2016 to see how the returns shape up. Single-digit returns is what Saurabh Mukherjea is expecting, and given the returns this year, doesn't seem like such a bad outlook for 2016. Always a pleasure to have you here on the channel. Bye for now, Saurabh. Thanks.